Anant, good morning. Thanks so much for joining in. Neeraj here. It's an interesting time to have a mid-cap conference, Anant. The markets have come off. Large caps are available very cheap too. I would reckon mid-cap valuations are probably the best that they have been in the last 12 to 18 months.
Partially correct. I mean, basically what has happened is mid-caps have corrected from the top. But at the same time, we've also seen large caps come off. So we also track this valuation or relative valuation between large caps and mid caps. And say a few months ago, that was at an all-time high, which effectively meant that the last 2-3 years, mid caps had rallied a lot more as compared to large caps, and the valuation had sort of peaked out. But even after this correction, because both large caps and mid caps have come off in tandem, that ratio hasn't come off a lot. So even now, the ratio, the relative valuation of mid caps to large caps on various parameters still comes across as almost close to all-time highs. So it's not that. So in absolute terms, maybe what you're saying is right, but in relative terms, I think that gap hasn't really come off.
Tell us about the mood at the conference. Are investors excited about deploying money in mid-caps in the recent correction? And what are you advising to them? What are the sectors or stocks which are looking interesting for a buy?
Right. So I think investors are happy about the correction that has played out in the last, say, 1.5 months or so. So the stocks which were just rallying without a break had actually now come off. Maybe some of them are 10-20% off the peaks. And now it sort of gives them a fresh opportunity to reevaluate the mid-cap space and check whether there are opportunities which are now emerging in various pockets. So that is the idea behind a lot of investors who've come up for the conference. So they want to find out two things. One is how the things on the ground are moving, and hear from the corporates about whether they are seeing signs of change in terms of growth coming back or order flows coming back, and secondly whether they are seeing any hopes in terms of economic recovery accelerating over the next few years. So they're trying to gauge whether it's a 1-year story or whether it's a 2 to 3 year story. So I think that's where all the interest levels seem to be, and obviously the bottom up stock picking is what is the flavor at the mid-cap conference.
Anant, if I look at your mid-cap recommendations or the list of recommendations, NBFC stocks are right up there. So the bias clearly is towards NBFC. So what's the thinking behind that? Why do you like an SKS Microfinance or Cholamandal?
Right. So I think one of the bigger themes that UBS has been talking about for about the last 1 year now has been that inflation in India is not structural, it is cyclical, and the government has been putting in efforts to rein in inflation, and we've already seen some signs of that in terms of how CPI is coming off and how WPI has actually gone into the negative territory for the last few months now. In tandem with that is our call that the wholesale rates in the system will come off. We've already seen part of that come off. We are saying that the 10-year yields will actually go down to something like a 6.5% by the end of next year. If that be the case, then one of the bigger beneficiaries would be rate sensitives, and that is where the NBFCs come in. So I think lower interest rates led by lower inflation would lead to highest benefits for some of these wholesale borrowers as in NBFCs. That's where some of the NBFC picks come in.
I know you won't talk about specific names, but I'm looking at some of the other themes that you like, and you constantly like the exchange business out at UBS, and I believe they feature probably in the conference as well. There is a flavor of the e-commerce business as well by virtue of the ideas that you guys like. What are the pet themes right now, aside of course, the NBFC theme that you just mentioned?
Right. So other than that, I think there are two things that we are really talking about. One is franchise businesses, which would do well in any kind of an economy, wherein the growth would continue just because of the huge franchise that the business has, and therefore the valuations will sustain on even if it means that we're starting off at a slightly higher level. So these would be the secular growth stories simply because of the brand value or the franchise value that the businesses carry. And the second theme is the cyclical recovery in the markets and cyclical recovery led by the recovery in the economy. And that is where our focus on quality industrials, quality cyclicals, quality cap good names come in. So I think these are the two pockets in which we see where the maximum money could be made. You could add financials as the cyclical element, but I think that's where we broadly want to position ourselves for the next 2 to 3 years.
Look at the high frequency data, which is the IP data, car sales. They are not pointing towards any great economic recovery. So does it make sense to buy into cyclicals right now? Because Indian economy has not recovered at all. Capex has not picked up. The money moving indicators are also indicating that yes, Capex cycle will pick up, but as of now, it's only yellow weeds and no green shoots.
Right. No, so I think that there's a little bit of mixed data over there. I mean, commercial vehicles is where we see recovery playing out to a smaller extent. And we have seen in the past that MHCVs have been a lead indicator to the rest of the passenger vehicle or vehicle side and lead indicator to the rest of the economy. So that's one point to remember. And secondly, when you're buying cyclicals, I think it is always better to sort of buy it when the news flow is not in our favor or the data is not sort of playing out. We're seeing enough signs on the ground wherein the government is making efforts to make sure that the economic revival takes place. We've seen that the coal issue is sorted out to a large extent. I think power issue is next, SOE banks is next. So I think there are few steps which need to be taken before which we see a meaningful cyclical recovery or a full-blown cyclical recovery. But I think if we have started to see first signs, I think it's better to start positioning ourselves now. We get stocks and valuations at a much better levels now when the news flow is not on our favor, rather than trying to catch the stocks when they've already started making a move.
Anant, so what is the UBS view on the market right now? While things are lean and you sense that right now is the time to fill up the shopping bags, how soon before we get back to, the top that the market was sitting on? And for the remainder part of the year, what is the kind of percentage gain that, the index could see?
So on the Nifty, we have our target at about 8,600 for the year ending. Now, the thing that we see as a disconnect in the market here is that after the March quarterly results, we've seen the street sort of downgrade the earnings for F15, but less so for F16. Now, what that has done is that the growth for F16 still stands out at about 20%, which we think is on the higher side. So our top-down estimate for growth on F16 is about 10%, and we think over the next 2 quarters, this would get reset, as in the street estimates for F16 growth of 20% would start getting reset towards 10-ish%, which is where I guess the base formation or the bottom formation for the market would take place. And from there, we will start seeing the market rally resume. So I guess we've got to digest this earnings downgrade cycle maybe over the next 2 quarters. But beyond that, I think we're still positive on the markets. 8,600 seems to be the target for the year end.
So Anant, closing comments from you. As we speak, we are at 8,100 or just above 8,100 on the Nifty. If your year-end target is 8,600, which means that you expect that in this year itself, Nifty or benchmark indices would rally by about 5 to 7%?
That is correct. But I think the thing to note over there is, I guess, if you are going through an earnings downgrade cycle on the street in the next 2 quarters, we may see the market languish or come off a bit as we digest those earnings downgrades. But I guess because of the overall positive view on the recovery, I guess there would still be enough buying support from the FIIs who want to take a 2 to 3 year view. That's where I guess the downside of the market could be limited.
Okay, Anant, we'll leave it at that. Thanks so much for taking the time out and joining us, and have a good day at the conference.